Hi everyone. So today's video will be about audit of inventory management. So when you hear inventory audit, it sounds very simple, right? Just count what's the stock and you're done. But unfortunately, that's exactly why this area is so often understated in audit planning. It is seen as very routine, mechanical, maybe even low risk. But in reality, inventory is one of the most complex and risk prone areas, especially in a manufacturing organization. So let's start at the beginning. So let's start with what is inventory. Inventory refers to all the items that are held either for production or for sale. So the key thing here is it's for sale in the ordinary course of business or in the process of production for such sales. So it includes your raw materials, work in progress, finished goods, spare parts, consumables. So inventory is meant for sale and it has a useful life of 1 year or less, and that is why it's a short-term asset, it's a current asset, and it is classified as such in the balance sheet. So the various sub-processes that are a part of inventory management are listed on the screen. So as you can see, it's not just physical verification. It includes material master management, material requisition, material issue, movement, storage control. So we will be looking at each of these in detail, where we'll see what are the risks and what you can test during the audit. Now, in addition to the sub-processes, in any given area that you audit, you will always look for policy procedures. So your SOP documents is something that you will ask from the client. You will read it. It will include the DOA, that's your delegation of authority. It will also include what are the procedures for each of these areas, and like we've discussed in other videos too, for all the policy procedure documents you need to see whether they are authorized, approved, they are periodically reviewed, and the access to edit is restricted to authorized personnel only. You can also check whether the SOP is complete in all aspects or whether there's a scope for improving the SOP. And additionally, in this video, we will be also looking at certain data analytics that you can perform in each of these sub-processes while doing your audit execution. So let's start with our first sub-process, which is material master management. Now, a material master is your database for the entire inventory. It has the unique identifier for every item in your inventory. So it includes your item code, description, the material type, whether it's a raw material, work in progress, finished good. It includes the unit of measurement, the costing method, the storage location, and also includes other critical aspects like reorder level, reorder quantity, lot size, and so on. So what is the process flow, or who creates the material master? So in a large organization, this is how it works. So the user department, let's say the production department or procurement department, will raise a request. So whenever they want to create a new material code in ERP, they will create a request which will have all the details required. It is approved internally within the user department as per their DOA, and then it is sent to the stores department or the designated department which has the authorization to create these master codes in ERP. So thereafter, there would be some system validations within the system to check for duplicates, to check for any missing fields, and there could also be a maker checker. And finally, with all the details being validated, the material code becomes active and it is available for use. So some of the common risks here are unauthorized creation or modification of the material data, or having duplicate item codes, or having incomplete or inaccurate data, having incorrect GL mapping, having inconsistent or incorrect units of measurement, having wrong material types. For example, a capital item is being tagged as inventory. So as an auditor, you can check who is authorized to create or modify the material master and whether the access is restricted only to these authorized personnel. You can also look for segregation of duties, which means that the person who is creating a record should not be able to approve it, or person who is performing material creation in SAP should not be able to perform other critical financial transactions. You can also check whether there are change logs which are automatically generated by the system and which can be reviewed to identify who has made the change and whether the change is valid and authorized. Then you can look for controls within the system to prevent duplicates. You can also check if there's periodic review performed by the team to identify duplicates or obsolete items so that the data quality is good, and check whether the mapping to the GLs is accurate, and also check some sample requests and see whether the information in the material master is accurate and it is tallying with the information submitted by the user in their approved request. And also you can download the data and look for any missing fields or any inconsistent units of measurements, and try to analyze if there are any duplicates based on any similar descriptions. So the next sub process is material requisition. So what is a material requisition slip or a material requisition note? So it is an internal document that is used to request inventory. So the production department, maintenance department, or any other department can request inventory from the stores department. So it does not involve a sale or purchase, it is just movement within the organization. So how does this process work? The requisition is created by the production or maintenance department or whichever user department needs the material, and it is approved internally within the department as per DOA. Then it is shared with the stores department, and the stores department will check the availability of the inventory. If it is available, then it will issue the inventory against the requisition, and system updates are made. So the issue of inventory is recorded in ERP. Now what happens if the material is not available in inventory? Then a purchase requisition is required to be created to procure the material from the vendors from outside. So that is why you need to remember this material requisition is for internal movement, whereas purchase requisition is for procurement. The purchase requisition process is covered in the procurement audit, and we have a separate video on the audit of P2P or procurement cycle. So if you've not watched that, you can watch that too. So some of the common risks in this process are requisitions not being created by authorized personnel or not being approved, excessive or duplicate requisitions being raised, or lack of proper justification for raising requisitions, or raising manual requisitions even though system-based requisition can be created. So the test steps are very simple. You can check for authorization, look at access rights, look at segregation of duties, look for duplicate MRN patterns, check whether the MRNs are complete, they are adequate, they are not excessive, and that will help you in your audit. So next we will cover receipt of inventory. Now what is this? Inventory receipt is the process of accepting the materials delivered by the vendors. So when you purchase the inventory and when you accept that, once it comes to the organization, that is nothing but inventory receipt. So there are two departments here which play a critical role. One is your security department, and then the other is the stores department. So the security department will physically verify the incoming goods. It will check the delivery challan and then create a gate invert entry. So this could be manual or it could be within ERP. And what does the stores do? The stores team will verify the goods against the PO and the gate entry, and then perform a quality and quantity check. Sometimes there's a QC department also, which will perform an inspection of the goods received. So that depends on the type of material. You may see this more in pharma or other regulated industries. And after it is done, then the stores department will create a GRN or a goods received note in ERP, which is based on the gate entry slip and the delivery documents. Now, some of the common risks here are a lack of gate invert entry or inaccurate, incomplete gate invert documentation. Now, this is more specific to the security department. So if your audit includes that, you can cover that too. It's not specifically a stores department function, but I've just included it here so that you get a holistic view of the process. Then there could be other risks, like the goods that you are receiving are not in line with the quantity mentioned in the purchase order, or they could be goods which have been received without a purchase order being raised. So this is something which is a bit overlapping with the procurement department audit as well. So you can see how everything is interconnected. Then there could be other risks, like the goods have been received but have not been recorded. There could be backdated GRNs, unauthorized GRNs, delayed GRNs. So these are the different risks, and control that can prevent these risks have also been listed on screen. So there are certain checks that you would do mandatorily, like look for access rights, segregation of duties, look at whether there's a match between the PO and the GRN and the gate and word, identify if there are any mismatches in terms of quantity, or check whether the inspection is being performed adequately when you visit the stores on site. So these are some of the things that you can check. So next we are going to cover material movement. So this is when the materials leave the stores department. It could be for consumption, transfer, repair, or return, and this is a routine part of operations. So there are different types of movement of inventory. It could be within the organization or outside. For example, material can be issued from stores to the production department for producing the goods. There could be interplant transfers, there could be stock transfers, there could be goods which have been sent out for repairs, or else goods which are being returned to the vendors because the quality is not up to the mark. So to manage this material movement, different types of documents are used by the companies. For example, the material issue note, transfer note, okay, and also the gate passes, like returnable gate pass and non-returnable gate pass. So returnable, like the name indicates, it means that the goods are expected to come back, so they will be returned back to the company. So that is why it is used when goods are sent out for repairs. But non-returnable gate pass is used when the goods are going out permanently. They will not be returning back to the company, and this happens typically when the goods are being returned to the vendors. So some of the common risks here would be unauthorized issues or incorrect quantity being issued, or it is not being recorded timely, or wrong movement type is used. For example, you want to issue the goods to production, but you're using a different movement type, like for transfer or for return. Then similarly, there could be a movement of goods without system update. So some of the things that you can check is whether movement of materials is happening only through authorized SAP transactions, it's being done by authorized personnel, and check whether there's adequate segregation of duties and whether there are system validations for the movement type and quantities. So for a sample of transactions, you can check whether the material requisition note and the issue note are matching. So that is, the requisition is also approved, then the quantity which is issued is in line with the material requisition note, and it is being done timely. Also, with regards to the returns and repairs related movements, so there's a risk that the goods are being sent under RGP. So that is, they are being sent for repairs, but they have not been returned, there's no follow-up, or the non-returnable gate pass is being used incorrectly. So returnable items are being treated as non-returnable, or gate passes are being issued without approvals, or gate passes are not being created. So all these are the risks arising with regards to RGP and NRGP. So as an auditor, you can check that the gate passes are auto-numbered when they are created, and there's a defined approval workflow before these are issued. And also check whether the RGP are being monitored with the expected return date and follow-ups are being done. You can also look at an aging report of all the open RGPs and see what are the controls to review these pending returns periodically, and ensure there are separate registers or logs if they are manually maintained for both RGP and NRGP, and check how is the security performing a match between the goods which are being moved and the gate pass which is being created. So on the screen you can see all the risks that we discussed, along with control activities and test procedures that you can perform. So if there are inadequate controls to prevent these risks, that can be your audit finding or observation. So the next process that we'll cover is for storage controls. Now I won't be spending too much time here because it's one of the easiest sub processes. It is very self-explanatory. So as you know, proper storage is essential to avoid theft, to avoid physical loss, damage, and to ensure compliance with certain regulations as well. So the risks and the suggested controls and test steps have been displayed on the screen. Additionally, I've also noted down some key regulations that apply when it comes to storage. For example, for pharma, you would have the Drugs and Cosmetics Act, then you have other state-specific fire safety regulations, then for other industries, you can have Factories Act, for FMCG, you can have the FSSA Act. So it varies based on the industry. So the next sub process is physical verification of inventory. Now this is a very common one, but it is a critical control because it helps to verify if the inventory recorded in the system actually exists. So your existence assertion is test it through the help of this control. It helps to verify if the quantities match, if the inventory is in good condition. And there could be different types of physical verification. It could be annual, year-end count, or cycle counts, or there could be surprise counts. Okay, so the key control here would be definitely to physically verify the stock periodically. Okay, but I've also included two categories here. One is own stock, which is stored at the entity's own location, but sometimes it could be that the entity has stockists or other warehouses. So there is a need to perform physical verification even for the stock held at third parties, or at least obtain confirmations from there. And when it comes to third party related controls, there's also SOC reports that can be used to place reliance, provided the SOC report covers the inventory related controls. It covers the design and effectiveness testing of the inventory related controls at the third party. So next we will be covering reconciliation, which is a follow-up to physical verification. So you cannot end with just physical verification. The company also needs to perform an inventory reconciliation. So what does reconciliation mean? So it essentially means comparing two sources of data, right? So in this case, it is the ERP data and the physical stock count. So let's say in ERP, we have 100 units of a raw material. But when the physical verification was performed, only 90 units were available, which means there's a difference of 10 units. So this needs to be reconciled. So the stores department needs to investigate and identify why is there this difference of 10 units. So let's assume out of these 10 units, 6 units were actually issued for production and 4 units were disposed because they've got expired. So they were disposed as scrap. So it means that these entries were not recorded in ERP. So the issue as well as scrap related movements were not recorded. So that means there's some weakness even in the material movement controls that we saw earlier. So now after reconciliation, what is the stores department required to do? They are required to pass the adjustment entries to ensure that both the physical stock and the ERP count is reconciled. There's no difference between the two data sets. So similarly, there's also a GL based reconciliation to ensure that whatever is there in your inventory and your accounting modules is accurate and it is reconciled. So always remember, whenever there's a reconciliation related control, you will have to compare two data sources, look at the accuracy of data for both the sources, look at the completeness of data, and see how is the reconciliation performed and what action is being taken after the reconciliation. How are they fixing the differences? So as you can see, there needs to be a reconciliation for the stock even at the third parties, and any differences need to be identified and corrective action needs to be taken. So the next sub process is for defining inventory levels. So why is this important? Because it helps to plan our material requirements better. It will help to prevent both sorts of situations, that is understocking, overstocking, and will help to make optimum use of a working capital, because if you end up overstocking, it will result in blocking of your working capital. So as you can see on screen, there are different levels: minimum level, maximum level, reorder quantity, then the safety stock, which is like a buffer stock. So this is important. Now, what kind of risks are there? So these inventory levels are typically defined when the material code itself is created, and thereafter they need to be periodically reviewed, and any changes have to be made in line with the planning requirements, in line with the production requirements. So whenever you review this sub process, you can check who is setting up this inventory level, what kind of approvals are there in place, is the access restricted, is it being done by authorized personnel, what is the justification for any changes in these inventory levels, and is it in line with the planning requirements or production requirements. So the next sub process is around classification of inventory, which is typically categorized as slow, non-moving, or obsolete inventory. So what does this mean? So slow moving inventory means inventory has limited usage. So it is not frequently used for production. It's not frequently issued. So it's slow moving. So next comes non-moving inventory, which has no movement over an extended period. and obsolete, which is like no longer usable. So even if you try to sell it, you will not get anything from the sale. So that's why you can say the net realizable value of that inventory is 0. Now, different companies categorize this inventory based on aging. So the range, indicative range, I have mentioned on the screen, but it can vary based on company, based on the policy, based on the industry. So let's say in our example, to understand this better, we have slow moving inventory, which is categorized as any inventory wherein no consumption or issuance has been done in the last 90 to 180 days. And if there is no issue in the last 180 to 365 days, then it is non-moving inventory. And if it is expired or over 365 days there has not been any issue, then it can be like an obsolete inventory. Now I have also put an example on the screen for easy understanding. So as you can see, you have different material codes and the last issue date for each material, and then we take the current date and compare to identify how many days have passed since the last issuance date. And this you can easily do by asking these reports from the client or downloading it from SAP. And then you can also perform a classification manually. Usually the companies themselves have an aging report and a classification which you can review for accuracy and appropriateness. So this classification is important because it helps in accounting, in applying provisioning or calculating write-offs. And it also helps in inventory planning because it will help to avoid procurement of the slower non-moving items in excess. So during your audit, you need to check whether the company has defined a policy for such categorization and whether the provisions are being made for such non-moving stock or write-offs are being done for obsolete inventory. So this also impacts ultimately the valuation of inventory, which is the next sub-process. So let's look at valuation so you will be able to correlate both these and understand it better. So coming to valuation, this is important because it will directly impact the true and fair view of the financial statements. So if the closing stock or inventory is valued incorrectly, it can impact the value of cost of goods sold or the gross profit that is reported by the entity. So you can see in bold, I have given the equations also. So that is why it is important to value the inventory correctly. So I've also listed the steps in the inventory valuation process. So we need to determine the cutoff, that is at the close of the year. We need to ensure that inventory which is only for that particular point of time at the end of the year is being valued, and for that there's a physical verification that we've already seen. Then as per the accounting standards, we need to apply the relevant costing method consistently. So it can be first in, first out or weighted average method. So if you need more details on this, you can comment and I'm happy to make a separate video on that. Then we will do an inventory aging analysis also. So this is where the slow and non-moving and obsolete inventory comes into picture, because whenever the inventory is obsolete, then it is valued at net realizable value. So that's your next step. So determining the net realizable value for those items. And then as per the accounting standards, it's valued at the lower of cost or net realizable value. So finally, you'll arrive at the valuation. Now then what happens? The company will determine the amount at which the inventory needs to be valued. There'll be certain journal entries for adjustments, and all of this happens after management review and approval. And as an auditor, you need to assess whether whatever methods they are following are in line with the accounting standards and whether there is documented evidence of management review and approval. So very quickly, as you can see on the screen, there are some risks and there's suggested controls also to mitigate those risks. So like we already discussed, inventory valuation, it could be incorrect, or other risks also like capital goods being classified as inventory or vice versa, or errors in the cost computation, or third party stock not being included, or the computation of work in progress and the valuation for that may be incorrect, and there may be no evidence of reviewal of the valuation workings. So you can consider all these risks while performing your audit. So I hope you found this helpful. We are almost at the end of the video, and I'll quickly touch base even upon analytical tests. And I have seen some of you have requested other videos on topics like R2R, treasury. So I will be preparing those also soon. I have been a bit slow because I was unwell. So if you do like this content, then please subscribe so that you can stay updated. Now, very quickly moving on to the last topic, which is on analytical tests. So this is basically when you have big data, and we have spoken about most of these when we were speaking about the individual sub-process, but here there's a summarized table already, so you can pause and go through at your own convenience. So it is basically trying to identify areas where there could be red flags, so it can help to pick samples for testing or focus on more risk prone areas, and that will help you in your audit.